Okay, stop whatever you are doing. Seriously. We need to talk about silver.
Yeah.
And I don't mean silver is up a few cents. Isn't that nice? I mean, we are looking at numbers right now that uh, technically shouldn't exist,
Hmm.
not in a functioning global market.
Yeah.
We are staring at silver hitting $125 an ounce.
It is a staggering number, but what makes it truly an emergency signal, and, I don't use that word lightly, is where that number is coming from.
Right.
That $125 price, that is on the Shanghai Futures Exchange.
Okay.
But if you look at the U.S. price, the COMEX price in New York, it's trailing, way, way behind at around $110.
That's a $15 to $17 gap per ounce. That seems...
Impossible. It's historic. You just don't see spreads like that in major global commodities.
So today isn't just about watching a ticker. This is more like a detective mission. We have a stack of research here describing what looks like a structural fracture in the global economy.
That's a good way to put it.
We need to figure out why the price of this critical metal, something we use in, well, everything from solar panels to AI chips, is basically breaking into two different realities.
Exactly. And this isn't financial advice. This is a forensic investigation. We are looking at a market mechanism that is screaming at us.
And just to set the scene for you listening, because the context really matters here, this all happened incredibly fast.
So fast.
We're looking at the fallout on a Tuesday morning, but the spark actually lit during Monday trading hours in Asia. Silver jumped $6 in a single day.
Before America had even poured its morning coffee.
Right.
And that speed is the critical detail. This wasn't a slow drift where prices, gradually diverged over months. This was a violent repricing.
A snap.
A snap. When you see a spread that wide open up that quickly, it's not just normal volatility. It's a signal that the bridge between East and West has broken.
Okay, let's unpack that mechanism, because that can sound a little abstract. Usually markets are efficient, right? That's the whole theory. If something's cheap here and expensive there.
Someone steps in. That's the concept of arbitrage. It's the bread and butter of global trade.
Right.
In a normal functioning market, if silver is 110 in New York and 125 in Shanghai, traders would swarm that trade instantly.
It's basically a free money glitch. You buy low, sell high, instant profit.
With almost zero risk. So they would buy the cheap U.S. silver, put it on a plane to China, sell it for that higher price, and pocket the difference.
So why wouldn't you do that?
Precisely. And in doing so, they would close the gap. Buying in the U.S. pushes prices up, selling in China pushes them down, and eventually they meet in the middle.
That's how it's supposed to work.
99% of the time. But here's the fascinating part. That isn't happening. Or, at least it isn't happening nearly fast enough.
So the fact that this $17 gap is just sitting there.
It implies the silver isn't actually moving. It implies a breakdown in logistics or availability or maybe even trust.
I saw a line in the source material that I think just frames this perfectly.
I think I know the one.
The physical market is screaming at the paper market.
That's it. It's dramatic, but it's accurate.
So let's clarify that for everyone. We hear paper market, physical market thrown around a lot. What are we actually talking about here?
So the paper market, that's usually your Western exchanges. The COMEX in New York, the LBMA in London.
Wow.
These are largely markets where people trade futures contracts. And a futures contract is, well, it's essentially a promise. It's a piece of paper that says, I promise to deliver silver at a future date.
But do they actually deliver the metal? Like, does it truck back up to your house?
Rarely. And that's the catch. Very often, these contracts are just settled in cash. You don't actually touch the metal. You just bet on the price. You win, you get dollars. You lose, you pay dollars.
Okay, so COMEX is kind of like fantasy football. You're trading players, you're looking at stats, but you aren't actually on the field. You're just betting on the outcome.
That is a surprisingly good analogy, yes. Now, Shanghai is different. Shanghai largely represents the physical market. When the price there hits 125, that is the Chinese market saying, we do not care about your paper contracts or your fantasy league.
We need the actual stuff.
We need the actual metal bars, we need them now, and we will pay a massive premium to whoever can hand them to us. It's a demand for immediate possession.
And this all tells us that the physical metal just isn't there in the quantities needed to close that gap.
Right. And if you look at the inventory data, this is where the detective work comes in, the COMEX registered inventories have been trending down a lot.
Okay, define registered inventories for us. I know there are different piles in the vaults.
Good catch. So in the COMEX vaults, you've got two basic piles. Eligible means it's just sitting there being stored. It's owned by someone, but it's not for sale.
Like a safe deposit box.
Exactly. But registered means it has a price tag on it. It is available to be delivered to fulfill those futures contracts. It is the liquid supply.
So registered is the pile of chips on the table you can actually play with.
Precisely. And that pile is shrinking. At the same time, the open interest, which is the total number of bets people are making, is still incredibly high.
So lots of bets, but a shrinking pile of chips. That sounds like a recipe for a squeeze.
It is the classic setup. You have New York saying silver is worth one thing based on paper, and Shanghai saying, no, it's worth way more, and by the way, we're taking it.
It feels like a shift in power.
It's a shift in price discovery.
Right.
For decades, New York and London set the price. They sat at the head of the table. But now, it looks like that pricing power is moving east. Shanghai is just bypassing the COMEX.
But the big question is why? Why is China willing to pay such a massive premium? I mean, 125 is a huge jump. Is this just speculation?
It doesn't look like speculation. It looks like, well, desperation or maybe extreme preparation. You have to look at the macro picture. The sources say China has been tightening export controls on other critical metals for a while now.
They're hoarding the raw ingredients of the modern world.
In a sense, yes, but it's also just industrial necessity. We often think of silver as money, coins and bars. But silver is absolutely mandatory for the energy transition. You cannot build the modern world without it.
The source listed some specific use cases driving this. We aren't just talking about jewelry.
No, we are talking about solar panels. And not just any solar panels. The new high-efficiency cells use significantly more silver paste than the old ones.
And China is the leader in manufacturing those.
They produce something like 80% of the world's panels. They need mountains of this stuff.
And it's not just solar, is it?
No. Electric vehicles use much more silver than gas cars. 5G infrastructure needs it. And what might be the big one right now? AI data centers.
I think a lot of people miss the AI connection. I didn't realize AI was a silver guzzler.
Well, think about what AI is physically. It's high-performance computing, massive data processing, minimal heat loss. Silver is the most electrically conductive metal on Earth. Better than copper, better than gold.
So if you're building out that next-gen tech,
you need silver to make it efficient, and China is the world's largest manufacturing economy.
So if they're paying a $17 premium, it's because the cost of not having the silver is even higher than that premium.
That is the industrial calculus, exactly. If you're a manufacturer, you prioritize getting the metal over getting a good deal. If you can't get the silver, the factory stops. This premium suggests that Chinese buyers either need supply immediately or, and this is the really intriguing part, they know something about future availability that the West hasn't priced in yet.
They're front-running a shortage.
That is the implication. They're securing it now while the West is still trading paper.
Okay, I have to pause here and play the skeptic. It's easy to get swept up in this narrative. I'm the guy who sees this and thinks, okay, this is crazy, but markets are weird. Could this just be a glitch? Could it all crash down tomorrow?
And you should ask that. Critical thinking is essential here. The source we're analyzing lays out a very specific bear case. Reasons this might not last. We have to look at the risks.
So what pulls the rug out? What sends the price back down?
First, this could be a localized squeeze. A technical issue on the Shanghai exchange. Maybe a few big players got caught on the wrong side of the trade. They shorted the market.
And when the price went up instead?
They got trapped. To get out of a short position, you have to buy. If everyone tries to buy at once to cover their losses, you get a vertical spike, a short squeeze.
Like a frantic game of musical chairs, but once it's over, the panic ends.
Exactly. If it's just that, once those players cover their bets, the buying pressure just evaporates. The premium could vanish in a day.
And then there's just plain old profit-taking, right? If I bought silver at $90 and now it's $125.
You're tempted to sell, as you should be. Traders sitting on 30% gains in a few days are going to be looking to cash out. That selling pressure naturally cools things off.
What about the COMEX? They aren't powerless. Can they just stop the price from going up if it threatens them?
Oh, they have tools. We call them regulatory hammers. The exchange can change the rules overnight. The most common one is raising margin requirements.
Explain that simply.
So, to trade a futures contract, you put up a deposit, maybe 5 or 10%. That's the margin. If the exchange suddenly says, markets are too volatile, you now need to put up 50% cash.
A lot of people can't afford that.
Right. They are forced to sell their positions.
Which crashes the price because everyone is rushing for the exit at once.
Exactly. It flushes out the speculators. Or you have the nuclear option, cash settlement.
Sounds boring, but I'm guessing it's a big deal.
It's a huge deal. Imagine you bought a contract because you need the actual metal for your factory. The exchange can just say, sorry, we don't have the metal, here's the cash equivalent instead.
It feels a bit like cheating. I ordered a toaster, and you're giving me your refund, but I still don't have a toaster.
It's exactly like that. It resolves the financial contract, but it suppresses the price because it removes the pressure to actually find the physical bars. It hides the shortage.
And finally, we can't ignore the big macro stuff, the dollar, interest rates.
Of course. If the US dollar strengthens, commodities usually drop. Or if we get a risk-off event, like a stock market crash where everyone just wants cash, silver could get dragged down with everything else.
Right. So, disclaimer time. The market is incredibly volatile. A $20 swing in either direction is entirely possible.
Absolutely. Do not chase a vertical line on a chart with money you can't afford to lose.
Okay, we have covered the skeptical few. We've been responsible. But let's flip back. What if it's real? What if the U.S. price has to race up to meet China's?
This is the bull case, the FOMO scenario. And there's a detail in the source material, a sort of mid-video reveal, if you will, that really changes the calculus.
Ooh, a reveal. What is it?
It turns out that Western institutional investors, hedge funds, pension funds, the really big money, have been largely absent from this rally. They are underweight silver. They just haven't been paying attention.
So this massive spike happened without the big Wall Street players even at the table.
For the most part, yeah. It was driven by Asia and physical demand. So picture this. Asian buyers are paying $125. COMEX is at $110. Suddenly, a hedge fund manager in New York wakes up, sees this arbitrage on his screen, and gets FOMO, fear of missing out.
Or just sees free money, so they start buying.
They start buying futures in New York, and that buying pressure starts draining the COMEX inventories even faster.
And those inventories are already low.
And we enter a state called backwardation.
Right, we hear that word a lot. Break that down. Why is it such a warning sign?
Okay. Normally, buying something for delivery in the future costs more than buying it now. You have to pay for storage, insurance, interest.
Makes sense. Future price equals today's price plus expenses.
Backwardation is the opposite. It's when the spot price cash right now is higher than the future price. It screams, I need this and now. It means there's a shortage of immediate supply. And if backwardation becomes permanent,
the paper market loses its credibility.
Completely. Why would I care about a paper price of $110 for next month if I know I can't actually get the metal right now for less than $125? The price is no longer set by the screen. It is set by whoever has the physical bars.
A global repricing.
That's the term for it. It's the moment the market realizes the paper promise is worth less than the hard asset.
And, for the regular person listening, maybe someone with a few silver coins in a safe, this actually validates something they've been seeing for a while.
It really does. If you've tried to buy physical silver recently, you know you're not paying the spot price you see on TV. You're paying huge premiums, $8, $10, $12 over spot.
Yeah, people always complain the dealer's ripping me off.
But in light of this news from Shanghai, those premiums weren't just markups. They were an early warning system. The physical market in your local coin shop was already disconnecting from the paper price. Now Shanghai is just confirming that disconnect on a massive sovereign level.
So if you're holding physical, you were right. The paper price was lagging.
It wasn't reflecting the true cost of actually getting your hands on it.
This is just fascinating. So where does this leave us?
Yeah.
If we had to boil this down to the three key takeaways, what are they?
First, this price gap, this $15 to $17 premium, is a structural anomaly. It is not normal noise. It is a sign of a run on the bank for physical metal in China.
Okay.
Second, it challenges the credibility of Western markets. If New York can't deliver the metal, they lose the right to set the price. The pricing power shifts to where the actual demand is.
Anchored.
It's the convergence. You have massive industrial demand from solar and AI colliding with geopolitical hoarding. That creates supply crisis that a simple price hike might not fix. You can't just print more silver.
We are definitely in uncharted waters. It feels like we're watching a battle play out.
We are. It's paper pricing versus physical reality. And right now, we don't know if the West will just accept the real price or if they will try to change the rules with cash settlements to keep the game going.
The unstoppable force meets the immovable object.
And in economics, physical reality usually wins. Eventually. The transition, though, can be very messy.
Well, this has been a wild ride. I feel like I need to go check the charts. But before we go, we always like to leave you with a final thought.
I think the question to ask yourself is this. We value everything in dollars, but if the world's largest manufacturing economy decides that having the actual physical metal is more important than the price tag, and the Western markets only have paper promises left,
Mm,
what is the actual value of a dollar in a world that runs on silver?
something to think about.
Yeah.
Thanks for diving deep with us. We'll be watching the numbers.
Stay curious.